Good morning, everybody. Thanks very much for joining us. The focus today is going to be on logistics. We're going to be looking at the outlook for 2022. So really interesting panel here. Let's just start with some introductions. My name's Richard Betts. For those who don't know me, I'm the publisher at Real Asset Media, and we run around 70, 80 of these sessions a year, looking at both sectors, I guess regions, but also hot topics. So really interesting, residential and logistics have been one of the big key kind of themes over the last year. So really interesting to be discussing that and the outlook for it. Let's start with just some quick introductions. Let's start with you, Frank, a quick introduction of yourself and P3.
Yeah, thank you very much, Richard. Yes, P3 is a leading European investor and developer of logistics and light industrial properties. We're active in 11 countries. We have a portfolio of 7.5 billion euro, 60% of which is located in Western and Southern Europe, and 40% of it is located in Central and Eastern Europe. We are owned by GIC, the Singapore Sovereign Wealth Fund, and we have the ambition to grow much further. So this is why we are looking for opportunities to develop, to buy, but also to find the right people to get the best talent in the market.
Great, thanks very much, Frank. Raymond, over to you. Just a quick introduction of yourself and Zalando.
Good morning, everybody. My name is Raymond Petzmann, VP Real Estate and Network Expansion for Zalando. I'm now more than 20 years. I was afraid to say it in the sector of logistics, and with Zalando, the largest pure fashion online player in Europe since almost 5 years now. Again, the time is really running, and overlooking all the expansions. We have big plans, so we are targeting for 30 billion GMV for 2025. So there's some logistic warehouses to be built in the next 5 years, I guess.
Great, thanks very much. Rory, over to you. Quick introduction of yourself and Clarion Partners Europe.
Thank you. I'm Rory Buck. I'm a partner and run the investment team over at Clarion Partners Europe. We are a fund manager focused on the acquisition and development of modern logistics across Europe. Key markets are Germany, Netherlands, France, Spain, UK. We certainly do a lot in CEE as well. We're ultimately owned by Clarion Partners, who in turn are owned by Franklin Templeton, one of the largest money managers listed on the New York Stock Exchange.
Great, thanks very much. And over to you, Michael, just a quick introduction of yourself there and Cromwell.
Thank you, Richard, and good morning to all. My name is Michael Bodie. I'm responsible for the Cromwell business in Germany. In this respect, I'm responsible for growing assets under management, growing the platform, securing new mandates, launching new funds, and then allocating the right product to these funds and mandates. For those who don't know Cromwell is a real estate investor and fund manager. We are listed on the Australian Stock Exchange. As a group, we manage about 7.4 billion of assets under management across Australia, New Zealand, and Europe. In Europe, we manage 3.8 billion assets under management, and we have 220 people on the ground in Europe, in 17 local offices and 12 European countries.
Great, thanks very much, Michael. And last but very much not least, Sally, over to you and Cushman & Wakefield.
Good morning. I'm Sally Brewer, and from Cushman & Wakefield. Cushman's are, as of course many of you know, a global property services advisor working with occupiers, developers, investors, and any stakeholder involved in property. We have about 30,000 people globally and thousands across Europe. I head the European Logistics and Industrial Research and Insight capacity and work closely with our colleagues across Europe, both in the research and insight teams, but also in the market-facing professional teams. So trying to understand and analyse what's going on across our sector.
Great, thanks very much. And thank you to everybody joining us there on the RealX platform. On the right-hand side of your screen, you'll be able to see that there's a Q&A and a comment button. So please do feel free to use those. One of the joys of it being live is that we can pick up on your comments and your questions and answer them live. Sally, let's maybe start with you. Obviously with your research hat on, I suppose, what have you been seeing across 2021, and how does that feed into particularly the key trends, as we move through 2022?
Thanks, Richard. Just to sort of set a very, very quick scene about where we've come from in 2021, and I think I've been told how many times I use the word bonkers to describe 2021, but I think there is really no other term other than extraordinary, which is perhaps another easier way of saying the same thing. It has been the most extraordinary 12 months, and I think we can all of us who are active in the logistics and industrial market know how extraordinary it was because of how busy everything felt. It was, in terms of occupational demand, which I'm sure Raymond will all talk about, but it was the strongest year that we've recorded on record across Europe at 46 million square meters. And it was also the strongest year on record for many countries, not just for Europe as a whole, but for major European countries like the UK, for Germany, for Poland, Spain, Czech Republic, Belgium, Hungary, and many markets beyond. It was the strongest year on record. And the huge demand coming from occupiers of all kinds of space, but particularly for new build and modern space, has also particularly fueled the development side of the market, which again we'll talk about, but has fueled enormous amounts of development, particularly on the speculative side, and particularly in areas which have previously seen little speculative development in recent years or ever. But on the back of such strength of demand, we've seen the availability situation or the vacancy situation across markets become even more constrained than it had been in 2020 and before. And we're now seeing markets routinely at sub 3% availability. And even with new supply coming on, such has been the occupational demand, that supply is readily being taken up either shortly after construction completion or even before, in many cases of where pent-up demand is so strong. And this, as we're all aware, both on the occupational and the development and landlord side, has of course been driving the rental situation. And rental growth has been absolutely extraordinary. We've seen rental growth in markets across Europe. Everywhere has seen rental growth, pretty much. Nearly every single market, not every market, but nearly every market has seen rental growth. And particularly in markets across the UK, particularly London, which in some cases has seen more than 50% rental growth. The Czech Republic, particularly in Prague, where rents have really soared in 2020, and in parts of Ireland, but many, many markets across Europe experiencing rental growth, especially in the last miles of infill style buildings where there has been such short supply. And that occupational story, the availability, the supply constraint, and the rental growth picture in particular, and the prospect for income growth has, of course, driven investor appetite to even greater heights. And more records tumbling in 2020 on the capital market side. Investment volume for year-end for industrial across Europe for 2021 ended up in excess of 65 billion euros. It's absolutely extraordinary volume in comparison to typically what we would expect of about 40 billion per annum. And we anticipate that there is far, far more capital continuing to target the market, particularly appetite for portfolios. More than 50% of deal volume last year was for portfolios, particularly on the larger side. And the huge number of active investors who are active in the space growing, particularly from the cross-border position. So investors looking to deploy capital in markets beyond their own shores. And that, of course, that weight of capital, and again, also the availability of product, of investment product being constrained, has hardened pricing accordingly. And we are seeing lowest level of, the tightest yields being paid across Europe in many markets, and regularly seeing sub 3% deals for substantial volumes in many established markets. So I think to say it's been an extraordinary market is fair. Bonkers is another way to put it. But it has been a market, I think, in unprecedented levels of volume, of activity. And that sets the scene for 2022 to think about what is going to happen in light of that backdrop, but also what we can see further down the track.
No, that's great. Thanks very much, Sally. Really interesting, and I should have got Dizzy Rascals Bonkers to be able to play every time you said bonkers there. But you're absolutely right. It has been extraordinary there. I think just to see that. Frank, maybe coming to you. I suppose, how sustainable is that? I mean, Sally's talked there about this extraordinary growth. In terms of the drivers, how sustainable is this? How long can this continue for, do you think?
Yeah, I think Sally laid out the broad picture, on all dimensions. So if we focus on the occupational side, and this is how I interpret your question, how sustainable is it? Because ultimately that's what drives the business. We do see a very healthy structural trend. So e-commerce is still the driver. But even the conventional logistics requirements are higher than they used to, because the traditional players are building in more buffers into the logistics chain. So there's strong demand on that. And so we believe that this will continue for the next year, certainly. Of course, all given that the general economic environment will remain stable. And we had some conversation on the news from Ukraine this morning. I mean, these are certainly not positive factors, but assume that on the midterm, the general economy will do well. We believe that this direction will continue. But of course, there are differences between the countries. So you can see, and it's absolutely right, on a European level, it's extraordinary. And we can confirm that, for example, in Czechia, as Sally mentioned, we have very strong demand. We saw very positive development in Germany, also in the Netherlands, also in France, also in Spain and Italy. In Central Europe, other than Czech Republic, the picture is slightly more mixed, like in Poland or Romania, even more. So we don't see this huge demand pickup, or at the same time, it's balanced by sufficient supply.
Great. Maybe just picking up with you, Raymond, in terms of the occupier perspective, what are you seeing there? And is that fundamentally upholding that kind of growth picture that we're looking at? What are you seeing as the trends? And maybe pick up on some of that from 2021 going into 2022 as well.
So it's always good that the developers and all the other partners on the property market enjoy it. So because we pay the party, but of course, what others think it's amazing, it's a bit more challenging for us. I think for us as Zalando, of course, we come with a lot of people, and cities are doing more and more tenders. So we still have access on land, but we see it more and more difficult with the situation and the construction prices, but we have not spoken about it, land scarcity. So it's definitely not an easy situation. And sometimes and I think the developer know this as well, when you do negotiations with the general contractors on the way, within 2 months negotiation, suddenly the price is 5% up again. So it's really a really challenging time. So, and of course it will be challenging to see how can we actually fulfill our growth and find the right properties. Is that still excess coming with the employment what we have? But I think it's also a very difficult situation for the market, that everyone has to stay reasonable, that we are not overheating the market by too much competition. So there should be clarity saying, okay, we have to stay to the market fundamentals. What is actually the rent for the location? And of course, a little bit up and down is always in the market, but nobody should get ridiculous and saying, now we make this auction and asking various occupiers to bid on the land, and then the price is going up and up, because that would be creating our own bubble and we would suffering maybe in 3 or 4 years. But overall, it's an interesting market. Everyone is keen, more and more players coming in. That's also very interesting. I'm always surprised that there's almost every once a new developer, a new investor entering the market, what Sally also said. And of course, that also helps us. There's more people with land propositions. And so overall, I would describe it as challenging. And it's also, it's sometimes also fun. If it's not always nice if it is so super easy. So challenges are also good for the business.
Good. And Rory, I just wanted to come to you. I suppose looking at the investment outlook for the sector, what are you seeing in terms of pricing, cap rates, yields? I mean, what are your expectations? And again, Frank, Michael, do feel free to come on this afterwards as well. But Rory, what's your sort of take on that?
Yeah, it's a good question. I think Sally made a good point that vacancy is very low. There's significant demand, and you're seeing rental growth in the statistics today. That I think is a little different from what we've seen over the last few years, and I think investors are now more confident to underwrite that in their models. I think that'll have a tightening effect on yields, but I think you also need to be cognizant of lending rates. Those have changed dramatically over the last couple of months. I think that'll have a negative impact in yield. So I think these things need to be balanced. Overall, I think the weight of money coming in will kind of enforce that yield compression, but I think it's mixed. I think you'll need to choose your markets, be focused, but generally, I think the core markets are still compressing with that anticipation of rental growth.
Okay, great, thanks. Michael, have you got the same kind of view as Rory on that? What's your take on it?
Yeah, no, absolutely. I mean, as said, you mentioned it's extremely exceptional, strong market also in Germany. I mean, just for Germany, we had an investment volume of a little bit over 9 billion last year, which is a 23% increase year over year, and which is the strongest ever recorded year. And logistics and light industrial is now the second strongest asset class behind office, with a share of a little bit over 15%. So we think the investment outlook for the sector is strong due to the reasons we mentioned, and everybody knows, on the occupational side and on the investment side. And there's a shortage of space and there's a shortage of product. So there will be continued pressure on pricing. That said, this pressure will be more or less pronounced across the risk-return curve in Germany, we believe at least. Arguably a little less pronounced for the core logistics, and likely a little more pronounced for the core plus and value add product. And we certainly believe as well for the light industrial product more pronounced.
Okay, great. Frank, feel free to pick up on that. Yeah, go ahead.
If I may add a slightly more critical component to it, I think yield compression, which we have observed in the past years, has been a cover for lots of challenges. So yield compression was basically the automatic solution for many things. So like cost increases on the construction side, which have been so significant over the last year and the previous year, and we are talking about 20-30% in some markets. Land prices going up. Yeah. So basically, the mechanics for the developers have changed, and surprises were all covered by the yield compression. But by definition, this yield compression cannot continue forever. And in an environment where we have more inflation, where the central banks at least slowly, even here in Europe, move into slightly more restrictive direction, this will not be the solution for the next year. And Raimund, that will have an impact on you as well. So there's only two solutions. It will become less attractive to develop for developers if the rent remains like it is, and the cost side develops as we observe it does. If there is this demand, it has to come with a readiness to pay higher rents. Otherwise, the setup doesn't work.
I agree, and that would definitely be difficult. And the question is whether it lasts for the next 12 months or 24 months. I still hope, and because it is also supply issues, that it will change on the construction side and steel prices and all the means what you need. But of course, it is very important, and I think for me, being on the occupier side, but of course, understanding real estate dynamics. So I also have the feeling it's for the first time since the last 18 months, I would say that we are further away from normal market dynamics or economics, because it's more supply and demand. It's just because there is no good product available. The investors are actually fighting for the good product, and that's the reason why you see more and more yield compressions. Not automatically. Usually, you could say interest rates, occupiers. So there was always a certain mathematical formula where you could actually say where is actually the yield. But in the moment, it's further and further away. And of course, it's also for us will be interesting whether the developer can still do it. And that's the important part, that we all try, to stay at a certain point reasonable. That's just the only thing what I can say, because the worst thing would be a bubble again, that everyone thinks now we can party again, and then the bitter awakening is coming in 2 years. So that's something what we should keep in our eyes and mind.
And Sally, how does that play into the weight of capital, for example? Because obviously logistics and residential have now been of growing interest in terms of institutional capital, and you can't simply pull everything out of hotels, office, and retail and put it into logistics without there being an issue. So I suppose, what are we seeing there, and what's going to be the influence of that?
Well, I mean, there's no lack of capital seeking exposure to the sector, not least because the value drive on investment on industrial and logistics is, of course, increasing the exposure to the sector for those who are holding, and therefore others, either looking to benchmark against or against whatever MSCI or whatever, to be able to say that they have an allocation comparable. And as the values go up, that then drives more requirement to be in the space, not least for the fact that the fundamentals of the market are strong. We have a strong demand supply balance position with growing rents. We estimate that there's over 200 billion euros of capital targeting the sector. That's probably gone up in the few days since I spoke to our EMEA cap markets team. But if you consider that the market, was 65 million last year, that's at least 3 times oversubscribed. In normal year, that would be 5 times oversubscribed. So that, of course, is playing out on the pricing that people are prepared to pay. As I mentioned, portfolios have been particularly attractive because of the big bang opportunities that they represent, being able to deploy a significant amount of capital in single transactions. That's not for everyone. And in fact, there are lots of players who are aggregating and then realizing those assets in this exceptional value situation, being able to realize that value appreciation through the aggregation strategies that they've deployed. It's going to be an increasing challenge. The development play that many investors have sought to be able to achieve higher returns and create product in an environment of a lack of investment product is becoming more difficult. And we've seen more and more developers pushing into new markets where they've previously not been active before. And when I say new markets, I mean new geographic markets. We're seeing speculative development in some geographies where we've never seen it before, or haven't seen it for years. Places like Ireland and Portugal, where we're seeing players from other markets becoming active in those spaces, seeking new opportunities. And new opportunities in markets where there is real growth, and we were talking about it yesterday, that the occupier market is where things start. Without the occupational demand, there isn't income, there isn't an occupier to take space, and there isn't someone for us to transact for. But it really does start with that, and such has been the burgeoning occupational requirement across jurisdictions in Europe, that it continues and continues and continues. So until things start to, I suppose, until things start to slow down in the occupational space in particular, and until things start to, I don't want to say normalize, but until they start to rationalize in terms of the supply and demand situation, which doesn't look like any time soon, I should add, given the constraint in some of the markets and the occupational requirements. And we're still seeing huge occupational requirements. That will continue, and that will continue to create attractiveness in the sector. Now, where that plays out with regard to interest rates and borrowing rates, I think somebody's already mentioned the inflation word. That will start to become more of a story, I think. And I think inflation in particular will have a part to play in the way in which we all feel the effect in the market, particularly on the occupational side. As consumer markets start to become more affected by the prevailing inflation, that isn't expected to turn the corner. It'll remain elevated in lots of markets across 2022. That may start to play out in consumer confidence and business confidence, in the ability to be able to have certainty of ongoing demand. And so that may start to, it's possible that it will start to become a bit more of a headwind to occupational decision making towards the end, over the course of 2022. And possibly beyond, depending on what happens on inflation. But that could be something that we haven't started to see really play out as yet. But there is still plenty of demand burgeoning in the market, particularly for good quality space, and that which is in relatively short supply.
Yes,
I was just going to add,
Rory,
I think a lot of that capital, and Sally, correct me if I'm wrong, but a lot of that capital is not European capital, it's international capital coming onto the continent.
Yes.
And I think what they are seeing is in their home markets, kind of what logistics has done already, particularly in Asia and the US. You know, the US, I think, has 3 times the logistics stock per capita than they do in Europe. And so actually a lot of people in these other markets see Europe as an opportunity to invest at a point in time that they have now kind of missed in their own home market. So I think there's a big anticipation of further demand. But I agree, it needs to be kind of tempered with expectations around inflation and kind of corporate success.
And Michael, is that what you're sort of seeing, that more international capital, particularly focused on the German market, or more domestic capital? What's your sense there from Germany?
Yeah, definitely a wall of capital, as Sally, you said, actually coming to the market with already existing investors and other investors who have recently entered the market. But we also continue to see new entrants. And these new entrants, for the first couple of weeks or months, they stand a little bit at the sideline, watching and observing the market, looking at prices, rents, yields, etc., but also for operating partners and service providers. But very quickly, they are ready to invest, and we see that definitely from, or expect that from Asian capital more after the travel restrictions have been lifted, but also from US capital, definitely.
And Frank, I wanted to pick up with you a little bit in terms of the challenges that we're seeing in the market. We've picked up a little bit on that, but I mean, do we think that this is to do with, is the main issue pricing? Is it competition for assets? Is it shortage of land, availability of last mile, or indeed things like labor shortages, or now, we're also looking at political risk, of course.
All of the above, obviously. Yeah. And as of course, I think as structurally healthy the demand side is, as competitive the investment side is. Yeah. So and Sally mentioned it. You have so many new investors coming into the sector who are running away from offices, from hotels, etc. And there's certainly no lack of capital, quite the contrary. I think if the fundamentals do not absolutely change, this will remain like this. And that means that people come in who are not sector specialists, who bet on a certain trend, who of course sometimes make very bold decisions. And we see that, and it was said as well, in particular on the big international portfolios. Because there are some players who just want to invest the money quickly in big chunks. And this is why on the big pan-European international portfolios, competition is the stiffest. And we have become even more careful on that side. And we have the capability. We also can do very big acquisitions, but we have become even more careful there, and look also more for smaller portfolios or individual assets in countries, which we can source because we have the people on the ground. And it requires, of course, more work, and it's to assemble the same amount of capital deployment. But sometimes we see better opportunities. And of course, when you have the competence in development, that helps. And this is why we are relying on development quite a bit as well, because when you come into the value creation at an earlier stage, of course, it helps to deal with the challenges. And yes, it is difficult to find land. So yielding product is expensive. Land is difficult to find. Permitting is more challenging, especially in Western Europe and Czech Republic. And we are looking more and more at brownfields rather than greenfields, because less municipalities are prepared to openly dedicate greenfields for logistics. They are searching for solutions for their existing used land already. And we address all these things because we believe on the long run, this is the right way, the right thing to do.
Great, thanks, Frank. Interesting couple of questions coming in. I'll pick up this one first from Tristram Frost. Hello, Tristram. Thanks very much for joining us. What may today's news from Ukraine do to European economies and non-European investors' appetite for Europe? And I suppose also picking up on that point, what that may mean in terms of supply chains. And of course, our thoughts also with friends and colleagues based out in the Ukraine as well. So I don't know if anybody wants to pick that up just in terms of the effect on Europe and potentially the appetite for Europe. Does that create more of a risk factor for CE, I suppose, especially, but also any impact on supply chains?
Well, I think the first factor, which we've already seen today, is on energy prices. Oil's already breached $102 a barrel. Brent crude's already breached $102 a barrel today, just on the back of the news this morning. So, and potentially with the challenges to the Nord Stream 2 pipeline running through, the German government have also announced that they're halting, could challenge the supply of energy. And the cost of energy, which of course will have another knock-on effect on inflation, both for consumers and for businesses. The other is potentially as you say, the supply chain disruption. Whether or not it will be significant, it will depend on how much the conflict, I suppose, or how long and how prolonged, how significant the ongoing nature of it, but also how much it spills into the disruption to neighbouring economies in particular, where there may be challenges, particularly on the manufacturing side, I would suggest.
It's just one thing. It's not a political discussion, but I think nobody should be mistaken that this is Europe alone. I think there is much more at stake. I think it's really the free world order. It sounds strict, but if Putin doing the speech, when the word Security Council is actually meeting, it tells us something. So if there is an impact, it will be everywhere, because it's not only Europe. So there is much more at stake. But however, we will hope that everything will find some solutions still, but it will have some impact. That's for sure, I think. And energy is probably the biggest point, what Sally said, also in the supply chain.
And Rory, from your perspective, do you think that's going to influence, I guess, international investors that you were mentioning? Is that going to influence their sort of desire to look, at Europe more broadly, or what's your sense of that, or is it too early to tell?
I think it's probably a little early to tell, but my gut is it will have some sort of dampening effect. You can already see in the kind of the European stock indexes, right, that there's a negative impact. I think a lot of that is energy prices, but just generally that contagion would seep into any investment class which is exposed to Europe. Generally, I think logistics, and we've talked about how strong those fundamentals are. You're going to come back into an area that you were initially concerned about geopolitical risk, you probably come into a sector with these dynamics. But I think it's a little early to tell if the negative impact will be enough to actually affect yields. My gut is it won't have an impact on rents, because that's just structurally being driven up by the inputs into development and the supply-demand imbalance.
Okay, good. There's a question come in from Ali, and Ali, I'm going to say that your surname is Taglui, but forgive me if I was wrong on that. So what Ali is saying is I think rental prices and land prices will continue to go up and up in logistics hotspots, and that in essence that there's a negative view to big boxes, and so there'll be more of a focus I suppose, on those urban logistics side. What's your sense of that? Is there more of a negative view on big box? I mean, Frank, you mentioned there that you're more focused on brown rather than green sites. Do you think there's going to be more of a negative kind of view on big boxes in general and logistics? What's your sense of that?
Yeah, well, I wouldn't share that because even this differentiation between big box on the one hand and urban on the other hand is of course not always the case. Yeah? So you may have big boxes if you define them, for example, as more than 10,000 square meters in urban areas, and then they are even used for last mile deliveries, and these are very healthy. Yeah? So big boxes as such, I would say, is not the issue. And even for the general big boxes, we see strong demand and supportive. Having said so, of course, the closer something is to an urban area, the more relevant it is for the last mile delivery, and that demand is very strong on that. But generally speaking, we see both areas, and in our portfolio, both are doing well, and we do not see significant differences.
To be honest, the city logistic or urban logistic, it's a kind of an urban myth, or almost, talking about it at conferences since 10 years, but there's not much volume going in. There is a need, no question that you need some urban logistic spokes, hubs, whatever, but it's really a small location. So you need something, it's a little bit like a retail distribution system, and that's maybe the main part what you're going to. So there will be something, but it will never ever replace the big market outside, because that's just a distribution or last mile thing. It's not a big topic, and that's since 10 years we're talking about it. But have you ever met a big investors making a lot of money in city logistic? I have not met anyone yet. So.
Quick question come in as well from Tarek here. Which is disruption of the supply chain is already here. It's partly a comment actually as well, but disruption of the supply chain is already here, and it'll be amplified by the geopolitical situation. Inflation will be the main challenge for the development strategy in the coming months. How do we control costs? So I don't know whether you're seeking advice there, Tarek. But I suppose inflation we've already mentioned a little bit. But I suppose, how is that going to impact on costs? I mean, Raymond, is that an issue, I suppose, for the occupiers particularly as well? What's your sense of that?
It's always difficult what to say as an occupier. In a certain way, of course, it has an impact because it's a low margin business, or in general, you have to pay all the logistic costs. But on the other side, rent is still a smaller part of it. So there are other elements which are paying much more into the overall costs. But of course, it is something scary, and it's also how unpredictable it is right now. You have to do a lot of adjustments. And again, what I said before, how we handle the question, we have projects where we just start construction in 2023, but we're assuming the construction prices from today, and there's no mechanism. Now, what happens actually when at this time the prices are lower again? So who's actually getting the money? At the same time, when they're going up, we have discussions also with board approvals or something. How can we actually make sure that inflation or something is in? And I'm sometimes laughing to the young guys in the company, said it was just normal 15 years or 20 years ago. Inflation was just something you had to deal with, and there was just indexes and something how you adjust it. But we also spoiled over the last 10 years or 15 years that it almost played no role. So there will be something where we have to live with it, but at the same time, it's always this inflation cycle that you try not to blow it up more artificially. So, and that's probably the biggest challenge, how you do it. Because if occupiers pay more, the customer has to pay more, so then you have to pay more salaries. And this circle, that's probably something what we have to try to avoid somehow. But it's difficult. It's definitely for the next for this year, I really expect no release on the construction side.
Okay, great. I wanted to pick up a little bit on some of the key markets. Maybe Michael, just with you, let's start on the German market, and then Rory and Frank, we can pick up a little bit, and Sally on some of the sort of key markets if we can. So just a quick sort of overview of the German market, Michael, for those who aren't watching.
Yes, I mean, as we said, extremely strong year last year in terms of occupier demand and investor demand. Extremely competitive market as well. We see more and more capital coming to that market from all over the world. And that leads to the fact as well that we see many investors, or more and more investors actually, going more granular on the individual transaction size, because once you go beyond the 30 million, actually, in competition is just even more fierce, and that forces many investors to go to more granular transaction sizes as well. What we also see in Germany is that kind of the premium in yield you pay for shorter leases versus a longer lease is really going down. So that is really narrowing, and that you pay almost the same yield of multiple actually for a shorter lease than for a really long lease. So this is just a couple of observations from Germany.
Okay, great. And Rory, I suppose, how are you seeing that, and in comparison with some of the other jurisdictions where you're investing?
Yeah. I think Michael makes an interesting point about the gap in kind of long and short income. And I actually think that we're probably in a place today, we may already have been there in some markets for a little bit, where shorter income will actually price tighter than longer income because of the expectation of reversion. And actually, I think people, especially in Europe, for so long, we've kind of aligned long leases with tighter yields. And actually, I think we're in a part of the cycle where you can destroy long-term value by signing a long lease with tenant options. And I know, obviously, occupiers and their kind of, their profitability is important to the grander scheme. But in terms of yield profiles and investor demand, I think we're now at a point where the cost of capital is rising, and it's really the acquisition of reversion which is going to be driving pricing. So we're seeing that in the Netherlands. We're seeing that in France. Particularly in those two countries as well, we're seeing a lot of political discussion about logistics, somewhat negative, I might add. Particularly in France, you have environmental groups which are petitioning against big box logistics, and quite successful in some places. And so what you're seeing is new markets opening up, where maybe people are more amenable to that. In the Netherlands, given the lack of labor available for these big box logistics properties, what you're seeing is kind of short-term laborers coming in for 2-3 months at a time. And again, there's a negative sentiment around that. And let's remember that municipalities, when the mayor goes to run, it's the residents that vote rather than the logistics operators. So there's kind of a bit of a public backlash against logistics, which again is reducing availability. When I think about a market like Spain, that's very different, right? That's almost a tale of two cities. You've got Madrid, which is got a huge population, but it's very flat, and so there's a lot of ability to develop new space. And so you haven't seen as much rental growth there. Whereas if I look at Barcelona, you've got the ocean to the south, mountains to the north, a strong population center with significant consumption. And so again, you're seeing significant rental growth and tenant demand there. So I think it's a little mixed across these markets.
Great, Frank. Feel free to come in on that with anyone's. But then I wanted to pick up with also on the kind of theme of ESG, which has been a big theme, obviously, in the market. And Gary, thanks very much for your question, and thanks for joining us there. How does design need to develop with regard to sustainability requirements and ESG? So if anybody wants to pick that up as well, but Frank, over to you.
Yeah, so first, I can confirm most of what Rory said in the respective markets, and of course you always have the two sides of the same medal. So the more restrictive the conditions are, the less open the municipalities are for further development, the stronger the demand comes in. Then of course the shortness and the potential for rent increases is bigger. And we see that exactly in the countries as Rory described it. But this is, let's not forget it, that's a relatively new thing for continental Europe. We have observed that in the US for quite a few years now. It has drastically come to the UK. And the question is, how will it happen? How will it happen on the continent? And we see some signals that there is rent growth, but will it pick up to the same levels as we have observed in the UK and in the US? I think this is still open. And so Western Europe is as it is, as described. And just to add the picture on CEE, and there I would calculate, or I would call Czech Republic rather being Western Europe in that sense, yeah. And but Poland, we still see that there's enough possibilities to supply, and it's easier to find land and permits. The same is true for Romania. The same is half true for Slovakia. Depends on which location you have, and that's the countries we cover. But coming to the ESG question, I mean, I think this certainly will stay this topic, yeah. And I didn't follow your discussion yesterday, but more and more companies are picking up. I think more on the investor side still. We don't see a big move yet on the occupier side pushing us for more ESG. So it's rather us taking the initiative, and only few selected corporates who have defined their own sustainability targets now are coming from the occupier side as well. And then it's mainly about the E. Yeah? So how can we reduce emissions? How can we reduce consumption of energy, or even produce some energy? Because with logistics, roofs, I mean, that's a natural thing. Yeah? There's not much you can do with such a roof, and so it's great if you put solar panels on top of them. And these are things we are working on. So and of course it's a long journey, and we have done the first milestone because we just sold 1 billion of green bonds to the market, and there you have to fulfill certain requirements. And in order to have a green bond, so we have put up our ESG strategy and our ESG green framework, and now we will develop this step by step. And all our new developments are already, for simplification reasons, you call it in certification to BREEAM excellent. And this will continue. And on the investor side, we don't see obvious price differentiation yet, but it will be just a requirement. You have to have it.
No question.
Sorry, Raymond, go ahead.
I just wanted to say, and you said it already, that maybe some big corporates, but I have to say for us it's a must. You know, the net zero carbon operations, there's no way behind it. So that's the must, and solar panels on the roof. So that's status quo. And the next thing is now what we have to tackle is the embodied carbon. So the construction material, that will be a big shift. What can we do better? Because the awareness, and even for me, you know, always looking in sustainability, I just became more aware over the last 5 years how bad concrete and steel actually is, and how much emission from the construction industry are coming. So there is something what we have to do. So that's from the occupier, and for us is that serious. Also for water harvesting, you know, with all the catastrophic things, you have to look with the roofs. How can you manage the water process better? That's something what we have to tackle. And then I also find it very interesting on the real estate side, but also on the corporate side, you know, from the finance sector, you know, I'm sometimes surprised that this has not been caught up by the press more, but the Glasgow meeting, you know, was actually a little poor, I would say a bit poor from the announcement, but at the same time, there was this Glasgow Alliance for Finance or something, you know, where all the biggest investors of the world actually made a statement what was much more forward-looking towards ESG or net zero. So I think the pressure will also come from the finances, and not only for real estate, so also financing corporates, you know, how the investments criteria or ETFs are managed in the future. So there will be a big push. I think there's no way behind ESG. And I know not every occupier is doing it, but sorry, Sally, you have to answer.
No, I was going to say that it's absolutely the first, if not the first, then one of the first questions that investor clients are asking us about assets when considering deploying capital. From the occupational perspective, it's more often the larger corporates who, for whom it's a bigger deal. It's aligned to their brand, their ethos, as well as their operating efficiency. But as the occupier becomes smaller, it becomes less aligned to their business identity and more about operational and cost efficiency. And so the ESG question slides slightly further down. That will change over time, particularly as ESG requirements through either legislation or through choice, for the businesses or their customers, forces changes to the way in which they transact on property, and also the landlords that they deal with, and the ethos and the approach that the landlords and the investors take to their investments. And so, it's a virtuous circle. I recently heard an interesting nuance to the ESG question, that instead of focusing on do no harm on the E side, if you like, or all parts of it, we're moving to a more sustainability question of not do no harm or do less harm, but do more good. And we're now moving to a position where businesses and investors are thinking that they want to actually contribute rather than just limit the damage that buildings or processes within those buildings or transport. We mustn't forget that we are involved in providing real assets for an industry that create an enormous amount of emissions and environmental impact through the doing of their business. And so being able to make real estate capable of supporting change in the transport side as well is hugely valuable. But it is that kind of embracing, thinking about the entirety of the operation and how real estate fits within that, and then how businesses, investors and occupiers make decisions, and developers, of course, hugely have their hand on the tiller. And in fact, I think developers in logistics buildings have been at the forefront of some of the changes that have really pushed through into the real asset space, partly because logistics buildings are somewhat less complicated than, say, offices or residential or whatever. So we have the ability to be able to make big impact changes through implementing them on large scale as well, because the buildings are huge. So, lots of buildings, not all of them, but you know what I mean? The idea that we have the ability to be able to change things. And we've got plenty of developers in our space, active in our market, who are really making the difference, not just on the operating carbon, but on the embodied carbon side as well, and thinking cleverly about how to use materials. I think that we will potentially, and we're starting to see legislative change as well, that will force the hand, not just on the way in which we build buildings and operate them, but how we transact them. And we're seeing that in countries like the UK, where there are restrictions on being able to lease or sell assets below a certain EPC grading. And that's escalating. And in the next year or so, we will have that ratcheting up to C, and below will not be transacted. So it's not just going to be a carrot. It's not just going to be it would be nice to do less harm. It would be nice to do more good. It would be good to align with our business brand, but it will be a compulsion, because we won't have a choice but to be better. The businesses won't have a choice but to make change that particularly does good.
And we'll definitely pick up on that ESG side, as well as logistics as well, from different angles at MIPIM as well. So anybody who's in Cannes for MIPIM, Torsten, I'm sure, can put in the links to those events that we're running there. So if you're interested in those, then an opportunity there to meet in person, both at some networking events and also some panel discussions like these, picking up on those points. I wanted to just come to you, Michael, quickly. There's sort of around 7-8 minutes left, so we're going to move on to a sort of quick fire route for the moment, and then we'll drill down in more detail for some of those when we're at MIPIM perhaps. And but Michael, I just wanted to pick up with you the point around diversification. We obviously mainly, it used to be discussions around industrial, and then industrial and logistics, and then mainly logistics. But I suppose, how do you see this at the moment? Because obviously there's increased pricing, we've all talked about there, in terms of the value for logistics. So how do you see that diversification? Is that via country, or is that via asset, the types of assets within the industrial and logistics sector?
Yes, yeah, Richard, you're absolutely right. I mean, we see basically, really, there are investors have two routes in particular in order to secure more value and better performance, and one of these is actually to increase the light industrial allocation, because I mean, light industrial like logistics, benefits from the same fundamentals, exposure to the cyclical economy and the online growth and the supply chain recalibration, but it is kind of a more bespoke and differentiated product. It is. We see light industrial as a safe class or sector to invest in. Obviously, it is more management intensive, so it might not be for everybody. So you need to have somebody on the ground with expertise and track record. But that definitely for some investors a route to go.
Interesting, Frank, and there's obviously been a lot of focus in other, if we're looking at residential, then a focus on, as you drill down then into senior living, into, crossing over into healthcare and different assets. In logistics, obviously there's elements like cold storage, there's data centers, things like that are beginning to attract more investor attention and have obviously been quite successful asset classes in the US. Is that something that we're beginning to see potentially more of here in Europe as well?
I think we see that, but we see it to a limited extent. And it's a question also of the philosophy you follow. Yeah? So on the one hand, you have diversification. On the other hand, you have competence. Yeah? And diversification works against competence. Yeah? So if you do too many things at the same time, you cannot be the specialist. For example, we believe it's important to have significant size in the market, which can be in a country, and in a certain segment of the market. Yeah? So we would not want to grow in too many sectors and too many markets before having this size, which comes with competence. And then, of course, cold storage is an element of logistics, and light industrial is very close to it. Data centers are already a bigger step because the operations logic is different than in logistics and industrial space. Yeah? So, but the driver for us is competence, and competence comes when you have critical mass and concentrate on certain things.
Okay, great. A quick question. I'm just going to try and deal with the questions that there are, and thanks for all of the questions that are coming through. We'll try and deal with them as many as we can in the limited time available. Stephen Oakden, thanks very much for this. Is employment availability becoming a key driver for development locations, and will we see development moving away from the usual centres? Or is the market still driven by logistics optimization? So I don't know. Is that going to be more of a focus? Where employees are in terms of the siting of the assets. If anybody wants to pick that up.
I think it's for us, and hence it is for the occupiers. It is also for the developers. So it's very important to find it. But on the other side, you also have to face reality that we live in a time, where there's a very low number of unemployed. So almost every location is bad. So then, of course, you have to look for alternatives. And I think that's interesting that it will move maybe slightly away from the blue banana or something, but it still has to make sense from a logistical point of view. That's always, I always used to say, if you look at Europe by night, where the light is, that's where the music plays. So, and there are not so many other alternatives. So you cannot go suddenly somewhere, very remote, but it's an important factor for choosing a site.
I think what's interesting is, we talked a lot about the E in ESG, but S, occupiers are very focused right now on wellness and well-being. And it comes from a kind of a war for talent, which you used to see in the office market. So we, in one of our developments in France, we just installed a running track for the occupier. We're seeing gyms being installed in developments in the Netherlands. We're seeing cafeterias that, very nice places to have lunch in these buildings that you wouldn't have seen even 2, 3, 4 years ago. So I do think that's coming through in all different ways.
Great. Quick question as well, that's come in on the Ukraine, and whether or not, if we then have a much harder border with Russia, what does that mean in terms of land transportation from China, for example? Does that mean actually that then there'll be more logistics facilities needed in places like Poland, CE, Czech Republic, in order to deal with that? I don't know if anybody's got a sense of that, or whether we're moving ahead of things slightly there.
I think we might be moving slightly ahead in terms of, the supply chains. We've seen over the past 2 years the importance of supply chain resilience, certainly, and the ability to be able to focus well on, certainty of routing. And I'm sure Raymond would speak strongly to that. But it's difficult to predict what's going to happen there, obviously, but also the strength of the routes that already have established. It's a burgeoning development, the land route across from China, but the majority still happens by ship. So the being able to shore up any volatility in that, I think, will happily be absorbed in the short term in the shipping routes. Over the long term, what that will mean is probably another question, but that will depend on how the situation in Ukraine plays out.
Okay, great. We're almost out of time, so just a quick kind of last question to everybody, which is, I suppose, where do you see the sort of main opportunities at the moment? So Michael, let's maybe start with you, just in terms of the opportunities that you're seeing for 2022 and going forward.
As mentioned, opportunities I think are in light industrial, and opportunities I think may also be in order to kind of go broader and go to other jurisdictions in order to not face the really fierce competition for logistics in Germany. So go to Italy, go to CEE, and diversify a little bit away. That's the kind of 2 points I would mention.
Great. That sounds as though you're trying to direct people away from your home market, Michael, to avoid more competition. That's great.
Or go to light industrial.
Thank
or
you.
Shift parts of your allocation to light industrial.
Great, thanks. Rory, over to you.
Yeah, for us, the opportunity is really the same it's always been. We kind of stick to our knitting. We invest in markets which are, near transportation nodes, good access to population centers, low vacancy, and high demand. And that's where we're going to see rental growth, and that's where we're going to be investing our capital.
Great. Raymond, last word from you.
From our side, of course, a different perspective. So from our business, we see lots of opportunity because e-commerce is growing. On the other side, I wouldn't call it opportunities because it's challenging the market to find the right land. But as I said before, I think we're in a good position. We're also a reliable partner. That's also, I think, very important, that when we negotiate with someone, we stick to our word and we keep it. So I look positive in the future from this perspective. But of course, for us, it's more, but for others, it's the opportunity is maybe a challenge for us to find our way through. Yeah.
Great, thanks, Raymond. Sally, over to you.
Well, I think that it's fair to say that there is a market for everything at the moment. So at every point across the supply chain, from the first mile to ports to the last mile in cities, and everything in between. And so it's about, I would suggest, the most important thing is considering the value of the assets to the occupiers, or the potential if it's development assets. And that then will govern the long-lasting value of the assets over time and within portfolios.
Great. And last but very much not least, Frank.
Yeah, thank you. Yes, we're in for the long run. Yeah, so we see opportunities in all the countries we're active in, and we will carefully select them and do those things which make sense for us. And ultimately, what counts is that it's the right product for the occupiers, who are then also serviced in the most excellent way, because on the long run, that's what we live on, and that's our perspective.
Great, thanks very much, Frank. Thanks very much to all of the speakers. Really interesting session today. Thank you also to you for your different questions, your different comments. Very active in the chat and the Q&A today. Thank you for that really interesting discussion. For those who want to take this further, then we'll be at MIPIM as I mentioned. So do feel free to sign up for those, and we look forward to seeing you, those who are going to be there in Cannes. And for those who aren't going to be in Cannes, you can also follow that on the live stream in the RealX studio, just like you did today. really interesting to get everybody's views on this. If anybody missed it, then you can catch up on, feel free to let people know that you can catch up with this on demand. And if you're already watching this on demand, then thanks very much for watching. Thank you very much, everybody.